Hey, welcome to the pod. I'm Mitch Goldberg, your host. This is called Be the Boss of Your Money. It's about you taking control of your money. Couple quick things to get into today. It's been what a busy summer, right? Does it seem like summer yet? I mean, it's 95 degrees out every day. I'm on Long Island. We've had I shouldn't be complaining about the heat given what people are going through in Arizona, Texas, and the South and Southwest. But nonetheless, we are busy, and I'm going to get out of here in a few minutes because I've got a really cool networking event to hop along to, and I'm looking forward to seeing a bunch of friends there. Welcome to the show. So, as expected, the Fed raised rates, but more importantly, what did Jerome Powell, the Fed chairman, say in his presser after that? What do we expect? What are we parsing as far as the tea leaves go? Couple of huge moves in some major stocks today. One move was down a lot from a major tech heavyweight, and it didn't really take the market down with it. But I want to ask you, are investors getting a little too complacent? I know people talk about that all the time. Is the market up too much? Did we come too far too fast? And I, for one, have been saying, no, we're fine. We're not there. We've got more room, I think, to go. But at some point, everyone is going too far for now. And maybe we need to start thinking about at least rebalancing, reallocating. So we're going to talk about that, because if this does apply to you, then this episode is going to be really, really important to you. Let's roll a quick intro. I'll be back in about 20 seconds. Back. Hey, look, while you're watching this, if you have any questions about what we're talking about, ask me in the comments, okay? The comments below. Hit me up in the comments. I'd love to hear from you. And if you have words of encouragement, words of wisdom you want to share, go ahead and share them in the comments, or just let me know where you're watching from. It's always cool to see that, and I'd love to say hello to you. Give us a thumbs up, a heart reaction, an applause, a wow, depending on which social media platform you're watching on. If you're watching on YouTube, please subscribe to my channel. I post a ton of content there. All the live streams are there for you to go back and check out. And I always post the snippets. I take about a minute or two of each snippet, sometimes 30 seconds. And I take 30 seconds or so to a minute and a half of each video that I do, each live stream, and make them into a new video. So, and I organize them for investing mistakes, interest rates, things like that, personal finance. It's all good stuff. It's all educational. But when you do give us a like, it means the rest of your contacts are probably going to see it, or at least maybe know about it. And you get to spread the good word about the educational content we're doing here. It's all about personal finance. Okay, first things first. I said the two most important things for the week would be yesterday and today. Yesterday with the earnings from Alphabet, which is Google, and Microsoft. Those came out. Google had a nice pop up. Microsoft had a nice pop down. We'll go over the size of the magnitude of the moves in a moment, but considering that Microsoft is a higher price stock compared to the other Dow Jones stocks, it is a member of the Dow, and the Dow is still able to overcome Microsoft's tough day. It just goes to show you that there is a lot of strength in other sectors besides tech. Google did have a big day, and it's a big component in the S&P 500, but not as big as Microsoft. So kudos to the market for overcoming what could have been a tough day. The major averages were barely off today, and I'll just let you know that major averages, it was an okay day for today. The Dow was up 82 points. S&P was down 0.02, 0.02%. It's negligible. It's not even fractional. Minuscule is the right word. The NASDAQ was down 0.12%. So overall, pretty flat day. The small cap Russell 2000 index was up 0.7%. So that shows you a broadening out, and it shows you that investors still have a proclivity for taking on risk. Small caps have been doing really well. That's like, we need to talk more about the small cap index, the Russell, because that's an index that just gets neglected by investors. We used to talk about it more. I'll have to bring that one back. Make small caps great again. Okay. Dow is up 82 points, 0.23%. Overall, I'm going to say this is a pretty flat day, but the real accomplishment, the Dow is up 13 days in a row. First time that's happened since 1987. And if the Dow could be up one more day in a row, 14 days, that would mark the first time the Dow's been up since 1897. 1897, about 6 months after the Dow was originally created. I think the Dow back then only had like 10 or 12 stocks, 12 stocks maybe. Back then, I know one of them was GE because that was the last of the original stocks to either be taken over, change the name, go away, or just be, eliminated from the index. The Dow Jones, we've been talking about that a lot. It's not really an industrial index. The Dow Jones Industrials, it's not an industrial index. By the way, you can't invest directly into an index. You could invest into a security tracks or mimics an index, if you didn't know that by now. But I will say that index investing is very convenient. It's a very quick, easy, and cost-effective and tax-efficient way to get broad-based exposure. Tax efficiency is a good thing. I'm not your tax advisor. I'm not your mama or your papa either. But if you have a specific tax question, you should always speak with your tax advisor. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And I think there's another one, past performance is no guarantee of future performance. Or we could I could literally just go on and on saying disclaimers and disclosures. That's what I should be for Halloween. I should be like a walking disclaimer, just like wear like a big t-shirt and just write every disclaimer somewhere on the t-shirt and just walk around like that the whole day. Of course, my fellow financial advisor nerds would get a kick out of it, and the rest of you would just think it's plain old weird. But all right, well, that's what Halloween's all about, though. It's about you get to be something different for the day, okay? I get to be different every day because I'm unique, and there's no one meer than me, right? There's no one youer than you. Something. What the hell were we talking about? Oh, yeah. So the Dow was able to overcome the Microsoft down day. Let's take a look at some of these stocks, how they did today. Let's take it to the tape. Take it to the tape. All right, I'm in. Let me get rid of these social media icons. By the way, if you're not following them, well, I know you're following me on social because you wouldn't be watching this if you aren't. But, go ahead and check me out on Instagram, LinkedIn. I'm everywhere. Facebook, YouTube. I am on Twitter. I don't really do much there anymore. I used to enjoy Twitter a lot. I don't particularly care for it anymore. And I checked out Threads just to browse on it. And it looks pretty good. It looks pretty fun. I'm not sure if it's going to become another Twitter, but Twitter or X as it's been renamed can't really find itself. It's not hardcore enough for conspiracy theorists, but it's too hardcore for people who just want to enjoy their social media and consume news and interesting and fun posts and pictures and see their friends. So it's kind of in between. So I don't think Twitter really has a place that's solid enough for it anymore to make it an attractive business, which is probably why the value of has been written down so much since Musk bought it for like 48 or 44 billion dollars. And we got my favorite person from down under, James. How are you, my man? James Wrigley says hello in Melbourne. He is also a financial advisor. If you're watching me from Australia, I behoove you to follow James, connect with him on Instagram and LinkedIn, because he puts out so much content about the annuitization and your Australian pension plan. I guess it's similar to the Americans' Social Security, but even more important than them for that. It's a major thing in Australia. And an Australian would look at me like, "Don't you know what you're talking about?" No, I actually don't know what this is. I only know a little bit about it because every now and then I watch James content. So follow James if you're in Australia, or if you're here and you're an Australian national. Hope I said that right. Okay, so let's say look, Microsoft is down $13 today. Okay. This up here, this is just aftermarket trading. I'm not paying attention to that, and I'm not trying to highlight that. Boeing the Beast was up 18%. Look at that. 18%. I'm sorry, up $18, up 8.7%. Duh. But so it was up almost $20 today. It scored a new, see that? New 52-week high. Union Pacific was up $22 and change, up over 10%. So our nation's biggest railroad. When you see industrials do well and you see transports do well, that's called Dow theory. And this is a Dow theory confirmation when they both do well. And that tells you that the smokestack cyclical part of our economy is doing okay. So that's usually a good harbinger for good things to come. And I don't know why I have, oh, I hit the wrong symbol. Stupid me. I hit FB and something else came up, but that's not what I was looking for. Facebook, as you know, changed its name to Meta. So the symbol is Meta. Okay. And Meta after hours is up. Okay. Meta, it was up $4 today in regular trading, but it's up. Stop doing that. It's up $15 in the aftermarket, up 5%. These are big moves. And even though Microsoft is off today, it has had a really big run so far this year. Even with today's down day, it still had a big run this year. All right. So, and we looked at the tech stocks. We looked at Boeing up $18, Union Pacific up 22. So here I am saying the market's complacent, but here's how I'm gonna look at it. Okay, we're seeing money move into the non-tech stocks, and we've been talking about this here in the show for a while. That the XLI, which is the big ETF, exchange traded fund that tracks the industrials of the industrial companies of the S&P 500. That's been at or hitting, or it's been right near new highs. It's been doing very, very well. But technology is up a lot. I was talking to one fellow yesterday. He's a representative from a big fund company, a really big fund company. And their flagship large cap growth fund is up over 40% year to date. Now, I was quick to remind him that they were down about 37% last year. Okay. So, but that's just the same thing with the NASDAQ. The NASDAQ was up a lot this year, but it was down a lot this year. But are we getting complacent? Are stocks up too much? Are we leaning too heavily on a handful of stocks? And I have been saying no, because we need generals to lead the soldiers higher. But now the other soldiers, the other stocks are starting to make up for some lost ground, not nearly as much as the NASDAQ, but the gap between NASDAQ and S&P and Dow is starting to narrow, not because the NASDAQ's going down, but because the other averages are starting to act a little better. And I could see money maybe coming out of tech stocks, large cap techs, and going into these other companies. But the earnings have been pretty darn good. The numbers coming out of companies like Google and Meta have been terrific. Even Microsoft, which the numbers were pretty good, they were really good. Just the stock, the stock had already been up a lot. We'll see what Apple has to say. Netflix numbers were really good too. Tesla's numbers were really good too. So these large cap tech related stocks have been just doing so well. Is it possible that they've gone up too much? I think the only way we could answer that is obviously giving it more time. But if we give it more time and you're taking the risk of your account going down a lot just to see if, to give things more time, is not really what you want to hear. And it's not really something that you want to act on that way, or maybe you don't want to be so passive. So my thinking is if you haven't rebalanced your portfolio, let's say you were 60% stock and 40% bonds, and now you're maybe 75% stock and 25% bonds, consider rebalancing back down to your original allocation, or at least get halfway there. Consider maybe taking a few chips off the table from your bigger winners and maybe buy something else. Now, I could tell you a few of the things that I'm looking at to buy, but if I say them now in the live stream, I'm going to come off like I'm making specific securities recommendations. And I think that's kind of a no-no on a live stream. Plus, I don't know who's listening. So maybe I'll say, here's something that's a buy, and somebody could buy it and they could lose money on it. And maybe they weren't prepared to lose money on it and they weren't going to invest in anything, but they did it just because I said so. You really need to have a one-on-one with me to discuss specific recommendations. However, the theme for me is that interest rates are more or less close to as high as they're going to get. And I am really thinking in terms of investing over the next few years, in terms of maybe seeing lower rates, not for a year or two, but eventually. So I am looking at some income producing assets that have already been smacked down. And I'm looking at some spaces in the energy sector because I think maybe we went overboard believing that we're not going to need energy. We're not going to need oil and gas anymore. When I don't think that's quite true. In fact, if you take a look what's happening around the world, natural gas is in very high demand because it's a really hot summer. So those are a few of the places, general themes that I like without making specific recommendations. Now, if you want to reach out to me and have a one-on-one with me and talk specifics, talk about your portfolio, are you doing everything you can to maximize and potentially maximize gains, potentially minimize risk based on your risk tolerance? Those are the important things to talk about. Maybe we need to uncover some opportunities that you could do financially that you haven't thought of yet. So I have a lot of ideas. I've been doing this for 34 years. So I have a lot of good ideas, a lot of experience that I bring to client relationships. So give me a call. Check out clientfirststrategy.com or send me a DM. And we'll set up a 15, 20-minute phone call and we'll talk and shoot the breeze. It's probably worth your time to do that. And I know it's certainly worth my time to talk to you. And thank you for taking the time to watch my content. All right. So whether or not the market's up too much, I think is the wrong question to ask. I think it's at what point do you need to make sure that your own personal finance is being reflected in market conditions? How about that? So now could be a good time to rebalance your portfolio. Now could be a time to say, when you ask yourself, instead of asking me, is now a good time to sell Facebook? Is now a good time to buy Microsoft? Ask yourself, where does it fit in my portfolio? What is it expected to do for me? And if you're just saying, well, I just want it because the stock could go up, that's not good enough, because maybe you have enough technology exposure. For example, if you have a lot of money in the S&P 500 index fund, even for an aggressive investor, you have, in my opinion, more than enough technology exposure. As a matter of fact, I think the S&P 500 is a really aggressive trade now because it is so heavily represented by a smaller handful of mega cap, mega size technology companies. So we really need to discuss what's the point? How does it fit with your overall portfolio? And how would you feel if it went down? Would it hurt your net worth? Would it hurt your ability to retire? What would it do to you regarding your other investments in terms of, would it force you mentally to sell everything, make a hasty decision? We can't control what Meta or Google or Microsoft, what they're going to do, but we can control what we do now ahead of time so that we know how to react when things happen. The reaction that I want my clients to have when the stuff hits the fan is no reaction, because they were proactive already. That is the best thing, in my opinion. So that's where I want to get you to. I think we've talked almost enough. Fed raise rates, that means rates on credit cards, car loans will go up a little bit. It doesn't mean rates on mortgages go up. Mortgage rates are more of a factor of long-term interest rates, and the long-term interest rates, the 10-year bond went down a little bit. As a matter of fact, interest rates across the board, even on short-term bonds, went down a little bit. Jerome Powell says, we might not even see a recession. Those are bullish words. We might not see inflation go down to our targeted 2%, though, for another 2 years. And it looks like, and we also said we need to see what our interest rate hikes so far have done to the economy. And we're just starting to see that now. For everything I could see, it looks like the Fed is on hold for a while. They're not going to raise, they're not going to lower. They're just going to leave things where they are and monitor the situation, data dependent, to see what they're going to do next. And I really don't think the Fed is in a rush to do anything at the moment. A year ago, the Fed was in a big rush to raise rates. They're not in a rush to lower them now, but they're not in a rush to raise them anymore either. So I think it's just steady as we go for the time being. In the meantime, you just focus on you. You be you, put some money away, invest some of that money, keep an emergency fund, and all these boring things that you're supposed to do, you have to actually do them. All right, I'm going to get going. I've got this event to go to. I'm excited about it. I'll be back tomorrow, and I think hopefully I'll have a guest tomorrow. I'll see if my partner Bobby wants to join me. All right, have a great day. Bye.